Hey, what's up, homies? Welcome back to the Homeys Real Estate Podcast. This is your host, Anthony.
I'm Angel.
I'm a realtor.
I'm a lender.
And hopefully together, we can give you a pretty good idea of what's happening in today's real estate market. We got a good one for you. We're going to be looking at Homeowner Equity Insights. It's a report by CoreLogic. They release it every quarter. We're going to be touching on Q4 of 2020. So with that said, Angel, what is homeowner equity?
So equity basically means the amount of money that you've made on your property. So if you have a loan amount of $400,000 and your home's worth $500,000, that $100,000 difference, that's how much money you have made and earned on your property.
Exactly, right? So it's principal pay down. If your home is $500,000, you pay down $20,000, you now have $20,000 in equity. If you have appreciation on your property, your home's worth $500,000, it appreciates 10%. You now have $50,000 in equity, right? If you have both principal pay down and appreciation, you add that together and that gives you what your equity is. So in that scenario, that would be $70,000 because $20,000 in principal pay down and $50,000 in appreciation. So for Q4 of 2020, nationwide, homeowner equity increased 1.5 trillion. That's up 16.2% year over year. Angel, what catches your attention about this?
Equity is always a good thing, right? So it's a good sign that the more equity that's built nationwide, it's a good sign that we're probably most likely not going to see, hopefully, any recession like we did in 2008 and 2009. It's a good sign. The more equity, the stronger the housing economy is.
Absolutely. And just to touch on what Angel said, right? If you have positive equity in your property, there isn't going to be a foreclosure. Foreclosure for people that are underwater on their property, that have negative equity, right? So positive equity is always good because now you can sell your property and you have something left over after you sell your property. It's always good when home prices are rising because it means that the economy is typically stronger, right? And it also gives buyers more leverage or homeowners more leverage to pull money out if they ever need it for other scenarios. So now let's look at negative equity. So negative equity is when you're underwater, right? It's when you owe more on your home than what it's worth. That number has fallen. Negative equity has now fallen 21% year over year, and only 410,000 homes have negative equity. That's only 2.8% of all mortgaged properties. It's 1.5 million homes nationwide. So 2.8% of all mortgage properties. Just 1 year ago, that was 3.6% of all mortgage properties and 1.9 million homes. So what catches your attention here, Angel, about negative equity?
It is low, extremely low, right? Nationwide, you can only assume that in Southern California, it's even less. So good sign that that negative equity is down. Another strong indicator that we shouldn't see any a bunch of foreclosures on the markets and pretty much bad loans out there. This should pretty much be good sign that it's going to be hard for people to foreclose on their properties.
Yeah, absolutely. And then just to give you an idea of what it was at its peak, in 2009, 26% of mortgaged residential properties had negative equity. Right now, we're at 2.6%. So that's 10 times less homes than what we saw at that peak. Really good indicators for the health of the real estate market. And again, negative equity can be if someone purchases a home, right, and they just bid more than what the home's worth because that's the way the real estate market is right now. And the home didn't appraise for the value that they put an offer in for. But remember, homes are appreciating really quickly, so you're able to catch up to what it's worth relatively quickly within a month or a couple months. So that takes me into the year over year home price increase, right? So I have a quote here from Chief Economics of CoreLogic. He said, compared with the year earlier, home prices in December 2020 were up sharply 9.2%, boosting the amount of home equity for the average homeowner with a mortgage to more than $200,000. This equity growth has enabled many families to finance home remodeling, such as adding an office or study, further contributing to last year's record level in home improvement spending. So what really catches my attention here is that with home equity increasing, that gives buyers and homeowners more leverage to be able to fix up the home the way they want, right? So yes, you might have to bid a little bit more to get into your home initially, but with time, you'll have the equity needed, right, to fix the home the way you want it. So it really opens up a lot of possibilities when home prices continue to increase in value this way, right? Because now you have more money to pull out, more money to spend for remodeling to make your house nicer or whatever scenario you would need it for. Is there anything that you wanted to touch on in regards to this, Angel?
No, I mean, again, good sign for our housing economy.
Absolutely. So let's look at negative equity state by state. So as I mentioned earlier, it's 2.6% nationwide. In California, we're only at 2.2% negative equity. So that's really, really good. Only 2.2% of mortgage properties have negative equity in California. Angel, what catches your attention here about the negative equity in California?
Again, so that means that in California, obviously, we're known for having expensive real estate, but there's a reason for that, right? So, when you purchase a home in California, you're gonna see gains on those properties fairly quickly. That's big reason why we're less than the national average, and yeah, it's a good sign if anybody's out here. Again, it's just all this goes to putting all this together. These are all good signs for the housing market, and it's just showing that. If you decide to buy something in California, you're most likely going to be buying a home that's appreciating fairly quickly.
Yep, absolutely. So really good indicator for the state of California. Now let's look at a micro level, right? So I want to look at Los Angeles County. What does that negative equity look like? In Los Angeles County, that's only 1% of mortgage properties. Right? This is extremely low. Basically, anyone who purchases a home, 99% of the time, they're going to purchase it with positive equity. So this is a really, really good indicator right here for the health of the real estate market here in Los Angeles and the surrounding area. San Francisco has the best negative equity rate, right? 0.7%. So really good indicators for not just Los Angeles, not just San Francisco, but probably for all of California, because we see this, we see the two metropolis here doing really, really well. Angel, what catches your attention here about Los Angeles County negative equity rate?
Honestly, I didn't even think it would be at 1%. I thought it would be a little less than that, just because how much homes are appreciating right now, but. Again, it's just a good sign for all you people interested in buying in, LA County. I'm sure Orange County is something very, very similar to that. I would assume maybe Riverside or Riverside San Bernardino is also something somewhat similar to that as well. Probably a little higher out there, but yeah, just a good sign for you people interested in buying in Southern California that you're gonna buy a home that's appreciating and it's not underwater, and it's a good sign for the economy.
Absolutely. So let's look at the equity gains state by state. So California was the highest equity earning state of the United States, right? We had about $54,500 on average in equity gains. This is good news for you buyers. It's just further showcasing that, yes, purchasing real estate could be a little bit expensive, but the gains that you can get out of it year over year are really high, right? That's a lot of money. $55,000 in a year in equity gains is a lot, right? That doesn't include if you're a renter, if you're a property, if you're an investor, the rent you're collecting, or tax write-offs. That's just equity. So there's a lot of other benefits that are tied into home ownership. So Angel, what catches your attention here about the state by state homeowner equity?
Yeah, I mean, I would have assumed as well that California would be the highest. Most likely in LA County, it's even higher than that 55,000. Like how we did in our last LA County report, homes were appreciating $26,000 in a month in LA County. So I'm sure it is much higher than that 55,000. Again, a good sign for anyone who's interested in purchasing these areas. When you purchase these homes, you're gonna be making money on it, right? While instead of paying for rent, something that money you're never gonna see back. You're not only are you paying down your principal when you make your monthly payment, but just because of the area in which we live in, you're gonna be seeing a lot of equity on your property built just in a couple of years.
Absolutely. Nailed it right on the dot. If you have the means to purchase a home, it probably makes sense to start looking pretty soon or now, just because there's a lot of equity that's being missed out on for those that have the means but haven't yet pulled the trigger yet. So let's look at the loan to value ratio nationwide. Angel, what is loan to value ratio for those that don't know?
Loan to value is basically how much loan you currently have on your property compared to what it's actually worth, right? So if you own if your loan is $400,000, and then your equity and your property is worth $500,000, you're at 80% loan to value, right? 20% of your home, you own it already free and clear. So if you sell your property, you'll be having that $100,000. I mean, obviously there's fees and stuff to all that, but just a general idea, $100,000 of equity to yourself.
Absolutely. So it's essentially the opposite of what equity is, right? So if in loan to value of 80%, then you have 20% equity, right? So what's really neat about this loan to value nationwide chart is that a majority of homeowners, I want to say at least 90% of homeowners have 90% equity or more in their property, right? This is huge. This just gives us a little bit more sense of security that, hey, you know what? If real estate prices start to decrease a little bit, 90% of homeowners have so much equity that they're going to be safe of any type of foreclosure, right? There's a very small percentage of people that have, 90% or less, 10% or less equity on their home. And again, as we've seen earlier, the average appreciation rate or the appreciation rate we've seen year over year is about 9.3% nationwide, right? In California and Los Angeles County, it's even higher year over year. So really good news for homeowners for the real estate market, that there's a lot of security right now in real estate just because a majority of homeowners do have a lot of equity already in their property. So all in all, I kind of want to recap this with Angel. What catches your attention, Angel, about this report from CoreLogic?
I think these are just a lot of strong trends and a lot of strong statistics that are showing right now that are, again, just kind of back up that the housing market shouldn't be seeing any crash soon, right? Not only with that, but along with banks. So back during the recession, banks were right before the recessions. Banks were lending money to anybody back then, right? Mm-hmm. Now banks, they don't lend money like that anymore. They're a lot stricter on who they lend their money to. And just to kind of give you an example of that, before when COVID hit, people were qualifying for an FHA loan at 580, right? Most banks, right when COVID started and they saw like how it was shaking up the economy, they raised that to 640. Now they've loosened it back up. Most banks are at 620, some are even back at that 580 mark. But yeah, if the economy does get shaky, banks are going to be a lot stricter on who they lend their money to, which is good for homeowners because that means that most likely we wouldn't see such a strong drop in home prices or so many foreclosures out there because they're giving out good loans and not loans to less qualified people when it comes to as far as their credit rating and stuff like that.
Yeah, absolutely. So the bank has definitely tightened up from where they were in 2008, 2009 when they had very poor lending practices. So that's really good news, is that the people that are qualified are very qualified buyers, right? They're a lot less likely to foreclose or not be able to be delinquent on their payments. So that's a good indicator that we should be looking ahead, right? Real estate prices are probably going to continue to go up for the next couple at least the next couple of years, in my opinion. I briefly want to touch on why. The three reasons why I really think home prices are going to go up and continue to trend in that direction is because we're going to have low interest rates through 2023. The Federal Reserve already announced that. I think that they might even push that off a little bit longer. That's what the administration is looking like right now. Number two is that the economy is changing, right? Rather than going into an office, a lot of companies are changing to a hybrid model where they're going into the office and working at home, or some of them are just permanent work from home from now on. And what we've seen is that these employees that are now working from home, they want to be more comfortable in their home. They want a house with maybe an office or somewhere where they can just have more space because they're going to be spending more time there, and they're more likely to invest into a house, right? As opposed to maybe staying in their apartment or whatever it would be. So this is another indicator that shows, hey, you know what? There's more buyer demand than we've ever seen before. I think that we're going to continue to see prices increase, right? Another thing that's really going to influence buyer demand and home prices is Biden's $15,000 tax plan that I don't think will be rolled out anytime soon, just because it doesn't make more sense to ignite more buyers when we already have 20% less homes on sale than we did a year prior. It makes more sense to ignite buyer demand when inventory starts to pick up, when buyer demand starts to tailor off, right? So then when buyer demand starts to tailor off in a couple of years and inventory picks up, then yes, enact this Biden $15,000 tax plan, right? And yes, a lot of people are going to want to take advantage of it. It's going to bring out more demand. And what we know is when there's more demand, prices tend to go up, right? So just because of this, I anticipate that home prices will continue to trend upwards for at least the next 2 to 3 years. Again, this is all speculation based off of the research that we've seen. But yeah, this is what my take on what the real estate market is looking like. I know me and Angel have touched on this before, but appreciation in Los Angeles County and the surrounding areas is really, really strong. We're looking at about 7-8% year over year. If you purchase a home with 3.5% down in 2 years, you're going to have the equity needed with the principal pay down and the appreciation to remove mortgage insurance, right? So it's something to consider that, hey, you know what? Yes, my payment is going to be a little bit more expensive because I need to pay for this mortgage insurance. But as soon as I get into my home, I'm starting to earn equity. In 2 years, I'm going to remove that mortgage insurance, make my payment more affordable. So even if your payment is really tight for the first 2 years, just know that it should get more affordable with time, right? So it might be worth tightening the budget for that 2-3 years until you remove mortgage insurance and free up that space. So this is all in all what I just wanted to touch on and give my 2 cents. Thank you, homies, for joining the podcast. I hope you enjoyed it. I hope you found it useful. If you want to see these charts, you can see them on our YouTube channel. So thank you, podcast, for having us. Angel, any last words?
No, I think, again, for anybody who has the means of buying, I suggest that you really do go look at and buy. And remember, equity and everything is all great, right? But most importantly, if you feel comfortable making a monthly payment right now, it's a great time to buy, right? That's always going to be the key. If you feel comfortable making a monthly payment, it's never a wrong time to buy.
Absolutely. But that said, thank you, homies. I appreciate it.
All right. Thank you.
Hey, homies, it's Anthony. This podcast contains my opinions and is for educational purposes only. It does not guarantee any projections and should not serve as a basis for any purchase or sale in real estate.